You know what I'm doing? I'm going to walk in. Okay, welcome. David Guest here. Today we're going to be talking about the numbers. The numbers, the most exciting part of any business is the numbers because they don't lie. So really, what's the numbers all about? We're going to be talking about finances. Probably one of the most dry, boring topics for most business owners. You know, most people are pretty good at saying, well, I give that to the accountant or I get overwhelmed by the numbers. We see things like profit and loss, balance sheet, and often people will glaze over and go, what does this all mean? Well, today we're going to clarify as much as possible what they mean, how to read them, and how they can tell you exactly what you need to do to fix your business. So the reason we call this webinar, The Numbers Don't Lie, is because they're very objective. See, often when I talk to people in business, I ask them how they're going. They say, we're busy. My question is, busy doing what? Oh, by the way, we are on a webinar. I'm not sure if you can hear me, so if you can just type yes into the chat window, just give me an indication of that you're online, that you're with us, and that you can hear what's going on during this webinar. So please feel free to chat. By the way, if you have any questions along the way, I'd love to answer your questions as we go. So please feel free to put them into the chat box and I'll make sure that I can address as many of those as possible. So before we start talking about numbers, let's talk about money. Because really, you know, money is an interesting topic. It's a very, very emotional topic for a lot of people. And when we talk about money, sometimes people don't like talking about money. Sometimes people love talking about money. But the thing with, I suppose, the whole topic of money is, my first question is, what is it? And what is money? Because often when I speak to people, they're shy, they don't like showing you their numbers, they think that they need to protect their numbers, so they hide them, and they don't like to leave financials with people. They don't like to talk about their profitability. So what money actually is, if we think about where money came from, money originated from, it was about transferring value. Because in the good old days, what we used to do is, before money, we actually used to barter. And what that meant is that if I had a farm where I grew corn, and you had a farm where you grew sheep, and I had lots of corn, but I had no sheep, and I was interested in getting some sheep so I could get some sheep's wool, I would walk over with a bushel of corn and I would trade it for a sheep. And now I could walk around with a sheep under my arm, and that was the value that I transferred. Now, it became very inconvenient for people to walk around town with sheep under their arm and a bushel of corn. So they said, you know what, instead of carrying these things around, let's create a note, what was called a promissory note, or the start of money, currency. And it was basically a value that we stated between the buyer and the seller that we could now use as a note to transfer that value to other purchasers. So why the history lesson? Because I think often people say money, you know, it's the root of all evil, or money doesn't grow on trees, or money is this and money is that. And these are all beliefs. The truth is that money is purely a measurement of value. You might want to write that down. Money is a measurement of value. So when we look at a business and we look at the numbers, what we're looking for is measurement. And when people say, well, you know, it's not about the money for me, I go, of course it's not about the money. It never was and it never will be. The money is just a measurement of value. And the secret to success in business is to generate value. And when you generate value, the market responds by giving you money. So the amount of money that's going through the bank account dictates directly how much value you're contributing. Now, there's a little subtlety here, because, you know, often people look at their turnover as the critical number in business. And yes, it is important to have turnover, but the real number that you need to be looking at is leftover. And what I mean by that is the gap between how much it costs to run a business and how much comes in the door. So the bit you get to keep, because a good friend of mine once said, it's not about the turnover, it's about the leftover. And what we also refer to that in business is as profit. So we're going to be talking a bit about profit, how it's measured, why you need to know your profitability. We're going to talk about other numbers within the business and how you can measure those. And we're going to simplify how you read your cash flow projections or your profit and loss statements or all your financials. Okay, so let's get started. Just looking for a few more yeses to make sure people can hear me. If you can't hear me, type in no. Obviously, you can't do that. But if you can hear me, type in yes. Now, the other thing I want to remind you is there is a little workbook that we have for this workshop today, for this presentation. It's just got a few pages with some charts that we're going to talk through. So if you've got a chance to download that, you should see that in a link on the right-hand side of your screen. Feel free to download that as we're talking. So Let's start by talking about why your financials are important, or why they make you glaze over, for more importantly. See, here's the thing. I often ask people, you know, the speedo. Let's talk about your car. In your car, there's a speedo. It sits right in the middle of the dash in a very prominent position. Is it important? Is it important to have a speedo in the car? Well, most people say, of course it's important. And I say, why is that? And it's so we don't get speeding tickets and we don't exceed the speed limit and we can drive safely. So here's my question. If there was no speed limit, if there were no warning signs, if there was no signage on the road telling you how fast you should go, then is the speedo still important? Now, some people will argue, sure it is, because then I can tell if I'm driving at a safe speed. How do you determine safe? Isn't that a function of how well you can drive, the conditions on the road, the type of car you're driving, all of the things around you? So the number on the speedo becomes irrelevant unless we've got something to measure it against. And here's where a lot of people in business fall over, because they're looking at their profit and loss, or they're looking at their balance sheet. Because they've got no point of reference or no speed warning signals, they actually don't know if the numbers are good, bad, or anything, right? So all they're really referencing is, well, how did we go last year? Oh, we're doing better than last year or worse than last year. And that's okay, because it's a point of reference. But my suggestion is that to get excited about reading numbers is when we can actually compare numbers with budgeted numbers, okay? So if you think about our cash flows, our P&L, our profit, our revenue, our turnover as a speedo that's telling us how the business is going, and we compare that to a budget, now it becomes interesting because I can compare what is actually going on to what should be going on. Now, I hope everyone's tracking so far. Fairly simple, but I want you to get the concept so that you get excited about reading these numbers on a monthly basis. I do want to talk about a couple of things here. First thing I want to talk about is one of my favorite topics. Which is the line. This is the line in business, right? The line in business is the one that we play above and below. And some people have seen this because they've seen some of my presentations before. This applies to the numbers as much as anything else. So let's start with the first thing that occurs when we ask people to show us their financials. The word shame. It sounds funny, okay? But often when I'll talk to people in business, they're a bit embarrassed about their financials. And why would you be embarrassed about financials? Because they tell the truth. You can be busy as anything in your business. You can be busy running around. You can be busy actually talking to prospects. You can be busy talking to clients. But the truth of the matter is the numbers aren't appearing in the bank account. Now, it is a bit embarrassing when you say, how come I'm so busy but I'm not making any money? That's a very good question. Because if the numbers don't lie and there's no money in the account, what that tells me is what your busyness is purely keeping you busy. It's not generating a result. So what we need to do is we need to be wary of, if I'm not comfortable with my numbers, if I'm not comfortable with sharing them, why? Because the other thing that I see people do is this one. They will justify all day long. They will justify why their numbers aren't there. They will justify why they can't produce them. See, sometimes the thing that people do is that they live in this situation where they don't want to read the numbers because the numbers don't tell them what they want to hear. And so we look at the financials, they're not giving us a profitability, so we're better off not to look at that because that keeps our head in the sand. And with our head in the sand, we can go to work, do what we love doing, which is serving clients, talking to people, but we don't look at the numbers and therefore they don't exist. Now, the reality is this is a recipe for disaster, right? Because if you don't know what's going on within the business, if you're not clear as to what the numbers are telling you, because I will tell you one thing, your financial statements not only tell you how you're going, they also tell you exactly where the problems are in your business. They actually tell you that. Any good accountant can look at a set of financials and go, there's the problem right there. Now, if someone can pinpoint a problem through looking at these numbers, then they can actually address the issue. But if we don't share those numbers, if we don't discuss those numbers, if we don't analyze those numbers, then it's like driving without the speedo in the car and wondering why we keep getting speeding tickets. The simple answer is, unless you know how fast you're going, how can you tell if you're exceeding the speed limit? Well, I was going the same speed as everybody else. That's justification, right? Let's not justify why we're not being successful in business. Let's get to the reality of things. The other one is this one. So I can blame my accountant all day long. I can blame my bookkeeper. I can blame my customers for not paying their bills, but the numbers tell me that that's happening. And if I don't have those numbers, I can't actually move forward. So we call this below the line. Above the line, there's two things that need to happen. And the first one is obviously this one. And the second one. Now, in relation to numbers, let's have a look at what these two words actually mean. My favorite one is this one. I often say to people, what does accountable mean? They go, that's to be responsible. And I disagree with that. I don't believe being accountable is being responsible. I think they're two totally separate words with two totally separate meanings. If we look at the word accountable, it has the word count in the middle of it. So when someone's accountable, they'll present their numbers because their numbers are the way they count their result. So being accountable means being accountable for your results, which means using the numbers to actually substantiate what has and hasn't happened. Being responsible is about how you respond. So the question is, if I'm not accountable, I can't respond because I don't have numbers to actually tell me what to do. But if I am accountable, if I'm counting things, I can now actually make decisions. So we're going to be talking about financials, and I just wanted to get your mindset around how we're going to read them and why we're going to read them. And the simple answer is that they have the answers to the issues within my business. And as we look through these, you'll understand how that works. So I can see some questions starting to come through. Please, any questions around financials, throw them in there and we'll try and answer them as best we can as we go through today. So let's talk about number one. If you've got the workbook, if you haven't, please download it. Really, really significant one, this one. It's called the cash gap. Now, if you look at the top of that page, you'll notice that it basically says how to grow your business into bankruptcy. I don't know how many times I've seen this happen. People grow their business, and the more they sell, the less they make. So how does that work? The more I sell, the less I make. All of a sudden, I have an overdraft, and the overdraft is growing. And I'm trying to make money here, and all I'm doing is losing money. And it's sort of really understanding what cash does, right? Because when we're in business, cash is just a measurement of value. Remember, we said that before. But so is all the numbers. Now, if we track where the numbers go, we just need to make sure we close some of the gaps. Anyone who's been in the game of property investment, what we know is it's not just the price you pay for the property, it's also the timing of the market. So I can overpay by 10% for a property today, and in 10 years' time, when the property doubles in value, that was still a good deal. But if I'm trying to buy and sell in the same year, paying over 10% over is not a great deal. So how does this relate to what we're talking about here? We've got a little timeline in front of you, and you'll notice it starts at 0, and it ends around the 120. It's all about time. Because when we talk about cash gap, what we're talking about is the gap that is created because of the way that we trade within our business. So let's imagine that we have this business that we've started, and at the start we started 0 days. We need to buy product. Now, if you're a service-based organisation, you're probably going to employ some contractors, or it's going to be you, self-employed. If you employ contractors, or if you buy product, you place an order with your supplier. Usually as a new company, they're not going to give you great terms, but you can use credit cards so you can pay. So what we do is we get this thing called stock. Now, when we put stock into play, what usually happens is we buy stock or we employ people knowing that once we've got them on board, then we can sell them. So let's call this stock in trade. And if we've got good terms with our suppliers, what happens is they turn around and they give us 30 days, which means when they ship the stock, they say, you know what, we're going to give you 30 days to pay. So we get the stock in, and around 30 days, we have to pay. And sometimes we carry stock, we put it on the shelf, or if it's employees, we put them out to work, but we can't invoice for their time until the work is done. So at that point, at 60 days, what happens is, that's usually where we do a thing called dispatch. Okay. What dispatch means is the stock leaves the shelf, or the employees have finished the job or the milestone, and we can now invoice for their time. So at that point in time, we've already paid for the stock or for the wages, but now we're waiting for the customer to pay. Now, if we're good, customers usually pay pretty quickly, but sometimes they don't. And I know a lot of people that get trapped in terms. And what I mean by terms is if you dispatch your stock or you finish the job and you send your invoice to the client says no worries, and you say due in 14 days and they ignore that and they pay it whenever they feel like. Now, why do they pay whenever they feel like? Because they understand the cash game, right? The cash game is this. If someone is willing to give you terms in business without charging you, that's cheaper than bank interest. So if you can afford to pay your bills as late as possible without getting into trouble, it's not such a bad idea, okay? Here we go, we've dispatched our stock and we go 30-day terms, and what generally happens is people say, yeah, 30 days is good, I like 30 days, but I'm going to give you 30 days from end of month, which means if I miss the end of month by 1 day, 30 days can turn into 60. Now, often people don't like asking for money. We don't like chasing money. We think people should pay because we've finished our job. We completed our job, we did a good job, we sent them the invoice, they should pay. So when they don't pay on time, what do? Do we ring them the day after it's late? Do we wait a week? Do we wait a month? Most people don't even have a policy around this. What they do is they wait until the customer pays. So we call this payables. And if we're good at credit control, we'll get this under control and we'll get people to pay on time or within a very short period of time. It's amazing how many people will pay when you ring and ask for the money. I know some people in business, their policy is we don't pay till we get a phone call. So if you're not making the phone call, they're not paying. And then when you do make the phone call, you go, why do I have to call? And I say, that's our policy. We're not going to tell you that. That's just how they operate. So what does this all mean? Well, in simple terms, it means this. I've paid money out of my business to my supplier on 30-day terms. I don't get paid sometimes for between 30 and 60 days by my customer. So the gap between here and here, which is where I pay and where I collect, this gap here, known as the cash gap. This cash gap usually appears not on my profit and loss, but on my balance sheet. It appears as debtors. And what I mean by that is people who owe you money. Now, if you're in a business that deals with large organizations, you will have debtors. That's a normal part of business. But what we need to do is we need to manage them. Because my concern with this cash gap is that the more I sell, the more I need to pay up front. And the more I need to pay up front, the larger the cash gap becomes. Now, sometimes it's not unhealthy to have a cash gap, but if we don't anticipate our cash gap, we can actually get into all sorts of strife. And we're looking at the bank account saying, hey, this is all going backwards, when in reality it's not going backwards, it's just that we're growing. Now, sometimes we need to structure our growth in a staged way so that we can manage this cash gap. So often when people say, I just need to get more clients, what they're not taking into consideration is how do I deliver? Because one of the dangerous things you can do is take all the orders and run out of resources or run out of stock, because you can burn your clients. I have a question here. When forecasting future expenses in your budget, what's an easy way to segment expenses into priority so you can see at a glance what you must pay? That's a very complex question, but I'll give you a simple answer. When we set budgets, okay, there's a couple of things that we need to look at. We need to look at how much we're bringing in. We need to budget for income, and we need to budget for expenses. And when we budget for expenses, what we're trying to establish is what's the longest term I can get with my suppliers. Now, the best thing you can do is negotiate the terms. But don't just pay late. Actually work out if you can extend terms. Because each expense, like, let's say, for example, you know, one of the things that power companies have done recently is they've actually started introducing early payment discount. Now, I look at an early payment discount and I say, well, that's actually a good deal. And what I do is I trade that against the interest rate I'm paying on my overdraft, and whichever one's better is the one I'm going to go for. Now, if I need the money to buy extra stock, now my question is, what's my cost of money? Is it cheaper to get it from my overdraft, or is it cheaper to get it by paying my electricity bill late, or these sorts of things? So it's constantly evaluating what is the expense, how much is the penalty for paying later, because it's really just interest is what we're talking about. It's really just interest. And then how do I assess when I should pay it? So the simple way to do this is really be looking at your bigger expenses and working out how you can actually defer payments and see if you can use money. Now, one of the best ways to do this is credit card. You know, we can use credit card to get an extra 30 to 55 days on our supplier without actually costing us anything. because some suppliers won't even charge for credit card. And if it's Amex especially, we also get the bonus of the points. But what it does is it allows us to regulate our payments into a deferred payment mechanism. So be prepared to ask, okay? Because what you'll find is most suppliers do have some flexibility in how they take payments. But if we don't ask, they're always just going to give us their standard terms. So it's a very important thing to do at least once a year, to go back to all of your suppliers or reevaluate what you're purchasing within the business and say, have I negotiated terms? Have I negotiated price? Because if you don't ask, you don't get. And we can actually improve this cash gap as well. One of the other ways to improve cash gap is to work on payables. Now, for some industries, it's difficult to get payment in advance. For other industries, it's easy. Now, if you can get payment before delivery, it actually changes the game. And things like eBay, for example, a lot of people have an eBay store, but what they don't realize is when someone purchases something on eBay, they say buy and they pay and then you ship. And usually their expectation is anything between 1 and 2 weeks shipping, which means we have a positive cash gap, not a negative cash gap, because they're paying for a product before we even ship it, which means we might not even have it in stock. So we can get their money, get their order, go and purchase the product from our supplier, ship it out, and not pay the supplier until way later, which means we're actually getting a bit of a bonus, which is a negative cash gap, or if you want to call it a cash surplus. So when thinking about cash gap, I just want you to think in terms of how do I minimize it? How can I sort of almost reverse it and say, can I get my money up front? Because if I can get my money up front, I'm getting the use of that money, and then I can deliver the services later. And that stops us from being hamstrung. Very similar to looking at property if we look at negative and positively geared properties. See, with positive geared properties, what that means is you've got more money coming in than going out. And what that means is I can keep buying them. With negative geared properties, it means I've got more money going out than coming in, but I have a capital growth, which means I might be making more money in the long term, but I don't have the use of that money. So I hope that clarifies it a little bit, but we'll get into this a little bit more in the next section. I just wanted to talk a little bit about another topic. So if you turn to the second page of your notes, you'll notice that there's a bit of a graph there. It looks a bit like this. We're going to talk about kinds of expenses, okay? Because in business, there is 2 kinds of expenses. Now, the way they're defined by accountants is a little bit confusing because we call them fixed costs and variable costs. So if we think in terms of fixed costs, what that means is over time, it doesn't change. That's not technically correct, right? Because if you think about what a fixed cost is, it's generally things like rent, wages, basically any other cost that's incurred in terms of running the business. Now, the technical definition of a fixed cost is a cost that is incurred regardless of making a sale. So if we pay telephone bills, that's considered a fixed cost, even though it varies. So even though it might be higher or lower each month, because we pay it regardless of making a sale, the telephone bill is considered fixed. So for the sake of today's discussion, let's assume fixed costs are constant and we pay them every month regardless of how many sales we make. Is taking a deposit useful in controlling cash flow? Definitely. Russell just asked if taking deposits is useful for cash flow. Look, my suggestion is I would always take a deposit where possible in business, because what we're doing is we're bringing cash forward. We'll talk a little bit about that very shortly. Okay, let's just continue on this path, and I'm going to answer that in the next slide. Fixed costs. So we're going back to here. This is what's known as fixed cost, and that includes anything that you pay regardless of making a sale in your business. Then we have a second thing. Second thing we have is a thing called a variable cost. Now, what's an example of a variable cost? Well, variable means it changes, okay? But in terms of business, a variable cost means a cost that's associated with delivering your product or service. It's sometimes known as a cost of goods sold, COGS. Now, that would include things like purchasing product to sell. That would also include things like paying for contractors to deliver a service. That could also include things like commission, which we pay to our salespeople when they make a sale. But the distinction here is that a variable cost is something that is incurred as a result of making a sale. So it's not that it's variable, it's just that it relates to making a sale or not. So these 2 costs, they're the way that we split things up. Now, the beauty of fixed costs is that we can usually go to our supplier and say, we know we're going to be working with you over the next 12 months. We have an agreement, or we have an ongoing relationship. Let's negotiate. If it's something like a lease, it's a bit more tricky because you usually sign up to a lease. But if your lease is up for renewal, you can renegotiate. The thing with variable costs is that as we sell more, we should be renegotiating anyway based on volume. So don't ever neglect challenging every cost within your business and saying, can I get it for better? Because part of your job as a business owner is to make sure that you are looking at the costs and keeping control of those. Control means not only not paying too much, but also means challenging every price that you're getting on a regular basis. My preference is annually. And if you look at things like even the percentage that you pay on credit card, if you use that as a transaction, you can always renegotiate these things. So just be open to it and be prepared to find out what the negotiated rate is. Now, if we add these two together, what we do is we get this new line. And this new line here is what's called total costs of running our business. Now, that's just a combination of those two. We add them together and we get total costs. Now, total costs in simple terms basically means every percent that goes out the door, our expenses, whether they be fixed or variable. This is the cost of running the business. So as we start our business, usually our variable costs are pretty low because we're not selling much. Then as we start moving, these add together and we start to get this growth. Now the fourth thing I want to talk about here is sales. So how does sales fit in? Well, just imagine there's a line that goes like that, and we're going to call it revenue. It could be called sales. It really doesn't matter how you define it. It's basically income. Now, when we start our business, our income's pretty low, and when there's a gap between our income and our total cost, this gap here, this is known as loss. So if you look at your profit and loss statement, and you see a negative number at the bottom, or a number in brackets, or a number in red, that usually means that you've actually spent more going out than came in. I mean, this is not rocket science. This is fairly obvious, but let me explain. There's a couple of key things we want to point out here. The first one that I want to point out is this magic point right here. What's known as the break-even point. Now, what is it? Well, in simple terms, it's when our revenue equals our total cost of running the business. The break-even point means we've broken even, which means we're covering our way. Now, the reason this point is so significant is because if we don't know what it is, how can we make sure that we're above it? And I'm not talking about knowing for the year. I'm talking about knowing on a monthly, weekly, and daily basis. What that means is how many sales do I need to make today to cover the costs of running my business? Because it's not so simple, right? It's got a combination of fixed and variable costs in here, okay? And we need to know that number so we've got a baseline to start from. Because anything under here is bad and anything over here is good. But that's not the key here, right? Break even is important to know, but it's not the target. What is the target? See, when we run a business, what we need to do is we need to actually set an objective or a goal or a target. How do we set it? See, if we speak to our accountant, typically the way we set our budgets for this year is we look at the last few years, we look at the trends, and we then extrapolate from there what we think we're going to do this year. Now, that's okay, but it's not great, and I'll explain why. Because when I use historical information to create a budget, what I'm assuming is that things will be the same. That's my assumption. If I say, well, we grew 10% last year, therefore we should be able to grow 10% this year, that's just telling me that you're not changing any of your strategy. What you're doing is just sticking with the same process moving forward. So not a bad way to do things, but also very much, you know, stick your finger in the air and let's see if everything goes well. So I suppose my next question is, well, how do we set our budget for next year? How do we set it? Because it's not an easy answer, because we can't crystal ball gaze and say what should happen in the marketplace. Some of those deals don't even exist yet. Now, if we look at the other side of this equation, as soon as we hit break-even point, you'll notice that now this revenue line is greater than the cost line. This is known as profit. Now, remember, this is leftover. This is the bit that we get to keep. And you'll notice a couple of things that happen here is as sales go up, the gap between our costs and our revenue actually increases. So when we're down here, doubling profit of the business doesn't mean doubling revenue. It just means going to there. Why does that happen? Because our fixed costs remain the same, and every sale we make after break-even point, after this point here, is highly profitable because we've covered our costs of running the place. Now what we're really doing is covering the costs of supply, which is the cost of materials or the cost of contractors. So as we start growing from break-even, it's very exciting. We can double, triple, quadruple, or even multiply by 10 someone's profitability without having to do more than just increase the revenue by small percentages. Now, the way this occurs is by making sure that we maintain control of our costs. Because the other thing that happens as a universal law is we tend to spend as much as we've got. Most people know what I mean about this. And what it means is if I give you more revenue, your costs will go up automatically and you'll just start being a bit less controlling of your finances. Now, people go, oh, no, I'm not like that. Well, I'll prove it to you because usually when business goes the other way and we start running out of revenue, it's amazing how much tighter we can get on how we spend our money because we have to, because if we don't survive. So back to the question, how do I actually set my budget for next year? Now, you'll notice in the topic for this particular slide, it says, creating a budget can be crystal ball gazing. The method to maximize profit and ensure healthy business growth is simple. What we need to do is we need to look at a thing called maximum utilization. Now, what does maximum utilization mean? Simple terms, it means how much can I possibly produce? Now, a simple story that I use to explain how this works. I was working with a hairdresser one time, and I always ask this question when I'm coaching someone in business. My first question is, what level are you running at as far as capacity goes? Most people think they're pretty good. They go, David, we're running at about 80% of capacity. I go, 80% is pretty good. And they go, yeah, we're pretty busy most days. And the only reason we're not at 90 or 100 is because we get cancellations and no-shows. And we can't really do much. Once someone doesn't show up, the seat's empty. And I said, oh, okay, that's interesting. So that means that all your hairdressers are busy. And they go, yep, they're fully booked most times, which is good. I said, how many hairdressers you've got? 3. I said, 3 hairdressers, that's pretty efficient. How many seats have you got in the salon? And she said, well, we've got 5. No, she actually said 8, not 5. She said 8. I said, well, what's wrong with the other 5 seats? She said, David, you don't understand. It's really hard to find a good hairdresser these days. We're so busy just managing what we've got that we can't get them. So her true capacity was, she was only at 40% of capacity, not 80% of capacity. But in her mind, she was flat out. So when we look at maximum utilization, what we're asking the question of is, based on your fixed costs, what is the maximum amount that you can push through your business? And what that means is if you've got employees that basically provide a service, how many hours can they bill per week? If you've got a warehouse, how many pallets can you fit in it? If you've got a shop, how much can you sell through in a week? Now, these numbers will become scary for some people. I was doing this work with a photographic studio, and what we established is their studios their sessions were an hour and a half long, and they were open for business hours and after hours. When we calculated how many sessions we could fit into a week versus the actual number, it was scary. What we found out is based on those maximum utilization numbers, they were only using about 20 to 30% of their capacity. Now, I don't expect them to get 100 easily, but what I do expect them to do is start setting budgets that are moving towards that maximum number. Because what we've got to do is we've got to optimize or maximize the use of our fixed costs, because that's how we make a profit in business. And remember, I've said it before, I'll say it again, it's not about turnover, it's about leftover. So start thinking in terms of profitability and not revenue, because revenue is something that really just tells us that we've got cash going through the business. Profitability is talking about how much we get to keep, and that's what the game is all about. Now, you'll notice at the top of this, I said budgeting for a profit. What does that mean? Well, here's my question. We know what fixed costs are, because they're costs that we incur regardless of a sale. We know what variable costs are. They're costs that are basically incurred as a result of a sale. So where does profit fit in? If I was to say to you, your income as a business owner, how do you pay yourself? See, the majority of business owners I meet, the way they pay themselves is one of 2 ways. They either pay themselves a minimal wage, and the way they justify minimal wage is they say, you know what, I'm building the business, I don't want to take money out of the business, so I'm only going to pay myself enough to live. Okay, fair call. So then, how do you get the commensurate pay for what you're worth? Well, when we make a profit, then I'll pay myself the balance. Okay, makes sense, in a way. But my challenge to that is, what you've just told me is that paying yourself is an option. Paying yourself is an option. Making a profit is an option. Now, if it's an option, what happens is, at the end of the month when there's not enough money to pay all the bills, guess who gets the pay cut first? It's the owner. The owner will either miss out on profit, or they will actually minimize the amount that they pay themselves because there's not enough money in the bank. Now, here's my concern with that, right? Anyone who's ever done any wealth creation courses, the first thing they teach you in wealth creation is you need to pay yourself first. Now, it sounds a bit weird. You say, well, how can I pay myself first? I've got all these other expenses. Because this is what happens. When you get to the end of your month and you run out of money and you look at those bills, and that question that I think Nathaniel asked was very valid, is how do I manage my expenses? So in all those expenses, you've got things like the tax man, you've got things like the rent, you've got things like the wages and telephones. Now, if you don't pay any of those guys, they basically just turn you off, which means you're out of business. So we put them up as a higher priority than paying ourselves. And at the end of the month, when there's not enough to pay me, I go, well, you know, I'll make it up later. Now, that's a bit of denial to me. That's a bit of maybe I'll pay it later, maybe I won't. Are you keeping a record of how much you owe yourself? So when we say pay yourself first, what I'm suggesting is that you should be budgeting for a profit. Now, budgeting for a profit means it becomes fixed. So we actually add profitability of the business to this line here, which then lifts our break-even point from just paying everyone else to paying everyone else and ourselves. And when we do this, psychologically, the business will shift. Because by paying ourselves, what happens is now we've got this ability to actually generate an income. But second of all, we're going to get a bit stressed if there's not enough money in the bank. So we're going to work pretty hard to find it to pay everyone else, because we've got the same problem we had before, where if we don't pay the tax man, he shuts us down. We don't pay the rent, they kick us out. We don't pay the employees, they don't come to work. Because isn't it true? Most of the time, you'll make just enough money to cover those fixed costs. And the rest of it's optional. And as long as it's optional, it doesn't become part of our directive. And so we sort of relax once we've paid those fixed costs, because profit's optional. Let's not make it optional, let's make it budgeted. And if we make it budgeted, then we're going to start to see some real profit come into the business. Okay. Let's get to the exciting part, the financial reports. One of my favorite topics, financial reports, as they are for anybody. What are they? Well, there's basically two reports you're going to get from your accountant. One of them is known as the P&L, and one of them is known as the balance sheet. Now, what are they? What's their place? How do they work together? And what do they actually mean? Okay, it's quite difficult to understand. Now, profit and loss is pretty easy. Because if we look at what a profit and loss statement actually does, it tells us how much we spent and how much came in. So how much money comes in, how much money goes out. So the first part of the profit and loss statement is usually a thing called income. This is at the top of the P&L. And at the top of the P&L, it usually says sales or revenue or turnover, and it usually breaks it down into the different categories. And that's all fine and well, and we look at that number and go, wow, look how much money came in. And then there's another thing underneath that, which is expenses. And those expenses is the money going out. And often we'll see all these expenses, oh my God, look at all that. So that income now gets all that deducted, and the little total at the bottom is either profit or loss. And that's why it's called the profit and loss. And so that's pretty straightforward, but what it's generally talking about is transactional things. So that's the income statement, and now we've got this thing called the balance sheet. So what does the balance sheet tell us? Well, the balance sheet tells us about a thing called assets. So what is an asset, right? What's an asset in a business? Well, there's a whole lot of assets in business, and there'll be things like stock, there'll be things like furniture, there'll be things like money sitting in a bank account, right, which is considered an asset. There'll be things like debtors, okay? So let's have a look at how this works. The balance sheet has, on one side, assets, and on the other side, liabilities. And what needs to happen is the assets need to balance off against the liabilities, which sort of confuses some people because this one doesn't balance, right? The income and expenses don't balance. There's usually a difference. There's either too much or too little. But this one balances. How can that balance? The only way it's going to possibly balance is one of the figures has to be a variable that we make up to balance it. And it is, right? Because one of the assets in our business is a thing known as goodwill or equity. And the equity number is calculated by looking at all of the other things and saying, well, what's left over when we subtract one from the other? So as an example, if we look at how this works in everyday life, see if someone has income, they have a job. Okay, and if I have income from a job, generally my income comes in. And if I'm not making a lot of money, I make enough to live what's called hand to mouth. My income comes in, it goes straight out as expenses, and I don't build up any asset or liability. Sometimes I will build up a liability because my income's not enough to cover my expenses. But this is how most people who are on the poverty line live. Now, if you're in business and you're doing this, you're living hand to mouth. It's sort of sustainable. You get to eat, you get to sleep, you get to not have a nice warm bed, all those sorts of things. but we're not building anything for the future. Now, when we're young, it doesn't really matter so much, because when we talk about succession planning or retirement planning, people go, yeah, oh, it's so far away, I don't care about it. So then what happens is, as our income increases, the bank starts to like us. And they go, hey, you make good income, we're going to lend you some money. And so when the bank lends us money, how does that fit into here? Because that money that the bank lends us is not income. It's not an expense. Well, it has an expense component, but what it is, it's actually a liability. The bank says, I will lend you $10,000 or I'll give you a $10,000 credit card. We get excited, we've got this credit card, and some people look at it and say, that's money. No, it's not money, it's a loan. Yeah, but I've got access to it. And so we start building up these liabilities, and things like credit cards are liabilities. So the middle class, what happens is they start sort of moving into this slightly different world where they have income, and that income's greater than their expenses, but because they've got this lifestyle choice that they make and they start overspending, they're actually dipping into here and paying interest on these liabilities. So the money's still going out, but we're now spending more money because we've got more extravagant lifestyle. Now, it's sort of okay because we get to have nice cars and nice holidays and a car loan and a this loan or that loan, but we're just working really hard, but we're not moving forward, because what we're doing here is we're not building any asset base. Now, what is an asset base? Well, an asset base is actually something that's of value. And so sometimes people call it a nest egg. In a business, it's called goodwill or stock. And what we're trying to do is we're starting to build up this asset base. So when we actually go to the bank and borrow some money, we use it to buy an asset instead of just lifestyle. And so we start moving into this stage where we've got enough income to cover our expenses, and instead of getting into liabilities, we start pouring that money into assets. Now, in the terms of business, what are assets? Well, assets are things like machinery that actually improves productivity. It might be things like buying your own office or buying your own factory through your self-managed super. Because by buying these assets, what we're doing is we're reducing our expenses because that asset has a return, and that return becomes income. Now, in simple terms, because I'm trying to make this simple today, people who live beneath the breadline or on the break-even point are doing this. And as long as they're doing that, they're running around in circles, and there might be cash coming in, cash going out, but nothing's growing. People who live on this side, where they're actually taking that income from their business and reinvesting it into things like marketing strategy, reinvesting it into things like employees, reinvesting it into things like systemization. They're starting to build this. Now, what's the big difference? The big difference is, with this one here, there's only one form of income, and that's labor. And that means I have to work to make my money. With this one over here, we're starting to build assets which are generating income as well as our labor. So we're starting to build the equity within our business. So when we're looking at things like the balance sheet and the profit and loss in our business, and I'm trying to relate this to business and to life, what we need to be looking at is how are these two connected? Now, how it works is simple. When this income expense equation is lower than zero, so we're making a loss, that money has to come from somewhere, right? So it's going to come out of the balance sheet. So it's either going to come out of assets, out of our bank account, or we're going to have to borrow money on our overdraft, which grows our liability to pay it as well. So the connection between these two is really simple. It's that bottom figure here, the profit or the loss, actually adjusts what's going on the balance sheet. Now, our goal as we grow our business is not about cash flow. It's about building our asset base. And the way we build our asset base is things like cash in the bank. It's things like investment property or investing in stock or investing in other things, and making sure that those assets are working for us. Because if those assets are working for us, they're going to supplement the labor component of our income. Now, that's a bit to take in. If you want to learn more about this, there's a couple of good reference books. Probably one of my favorites is Robert Kiyosaki. Robert Kiyosaki wrote the book Rich Dad, Poor Dad. And the other one that I recommend to anyone running a business is called the Cash Flow Quadrant. And what he talks about in those two books is really understanding the nature of this, how it applies to your daily life, how it applies to your investment portfolio or strategy, but also how you can apply it in your business. Because as we get smarter in business, we start to realize we don't want to earn money, right? We don't want to work for a living. We want to build a business that actually feeds us. Because the reason we want to do that is so that we've got succession, we've got redundancy, we've got some resilience in what we're doing, and so that we can actually take a little bit of time off if we need to, or if we choose to, while still making an income. So part of this asset base here is potentially putting good employees on and training them. So we really need to start thinking in terms of how do we build that value within the business or the goodwill. Now, when it comes to building value or goodwill in a business, there's only two ways to do it. When someone values a business, they're looking at two things. First thing they're looking at is, who are your clients? So who are your clients? Where are they coming from? How sticky are they? Because I'll pay for clients if I'm buying something like an accounting firm or an insurance book. But I'm not going to pay for clients if I'm dealing with someone who's like a brain surgeon, because I don't know if those clients are going to come back, and they might not want to come back to me. So we're going to look at the client base and the value there. Then we can break that down into two components, which is clients who pay money and database. So how many people you have that you have a relationship with. The other side of this equation is your business system. So building the business system gives it a value, and that's why people pay for franchises. A franchise is basically a system that you're buying that allows you to go out and start a business and get into traction straight away, because you now have something to follow. So here we are building our own business. We're looking at the financials and we're saying we want to build value into the business. And the reason we want to build value into it is so we can either sell it, or it actually is easier for us to run on a daily basis. And the way we do that is by starting to focus on how do we build up our asset, which is our business equity or our business goodwill. So I hope that makes sense. I noticed a few questions coming through. I have left a couple of minutes for questions. So I'll just see if I can get a couple of those before we start to wrap up. Oh, yes, go on. Can I have a profitable business and still go bankrupt? The answer is absolutely yes. Right? You can make a sterling profit but not be able to collect it. One of the reasons we go bankrupt in business is purely cash flow, because there's another sort of really important point for people, and that's cash. Cash is king. You run a business, you need to make sure that the cash is flowing. Profit often is measured by looking at how much we invoice versus how much it costs us. But if that money is not coming through, I'm strangling the business, which means I need to go and find the money elsewhere. So I can make maybe 10, 20% profit on a product, but if I'm putting it into debtors and they're not paying me, and I'm paying an overdraft of 15%, I've just lost all my profit. So in simple terms, you can grow bankrupt very easily. Be really, really careful about how you do this, because if we're not using the cash to regenerate the business, then we're going to run into all sorts of strife. Now, just another question that came up before I saw was really about budgets. Now, how do you create a budget? Well, I have got a simple spreadsheet that I put together with Lex from my office, and it basically helps it helps people think through, how do I budget my expenses? You know, that was one of the questions that came up before. There is a methodology for doing this, and how we do it is we start by analysing last year's expenses, and we start by looking at those and questioning which ones of those we can work on. So I've created this spreadsheet with Lex. There's also a video attached to it. Now, what I do need is you can download this. I think Ashley can put the link up to the landing page. If you can see that link there, what you can do is you can download the spreadsheet, which will help you put a budget together. I'm keeping in mind that the financial year is upon us. So what I'd like you to be thinking about is, what's my budget for this next financial year? Now, when you download that spreadsheet, you'll also understand that there's also a video that I've created with Lex that is actually, it's a screencast, I think it's called, where we actually go through and show you where to plug the numbers in. So what I'd like you to do is invest the time, because probably one of the key parts to a business plan that most people don't invest their time in is the numbers. See, fundamentally, a business plan requires the numbers to be clear and accountable. So getting this budget in place could take several hours, but it's probably worth every minute that you spend. So please download the spreadsheet, watch the short video, have a go at filling out the budget, and see if you can get some clarity as to what you're going to be working on over the next year. Very clear explanation, thank you. Do you offer any more in-depth courses, David? Good question. We do. See, part of what we do here, as a business coach, my number one role in life is to help people improve profitability. We actually are running in, when is it actually, in about a week and a half, 2 weeks' time. In 2 weeks' time, we're running a course which is called FBI training. FBI, dark glasses, all those sorts of things. It's not that at all. FBI stands for Financial Business Intelligence. And it's a 3-hour program. And what we do in that program, because I can talk to you about numbers all day long, but unless you actually sit down and calculate some of them, a lot of this will be like talking hieroglyphics to you. So in that course, it's a half-day workshop. We actually work through some of the calculations to show people how to calculate profitability, how to work out what their most profitable items are. We talk about cash flow projections versus budgets, because there is a difference. Remember, we said cash is king. So the budget is what we're aiming for. The cash flow makes sure that we're not starving when we're growing. So we go through all of those in the workshop. I'll send details out of that workshop straight after the webinar. We'll send it to everyone. Is that all right, Ash? Excellent. We'll just send that to everyone. If you're interested, click the link. I think we'll also put a bit of an incentive in for those guys who have actually had the patience to sit through today to hopefully make sure we can get you on board. But just remember that the financials are like the dashboard in the car, right? We need the speedo, but we need also a speed limit to make the speedo useful for us. So by working on a budget and by also reading the financials on a regular basis, we can really see what's going on within the business and we can be accountable. Because if the numbers aren't stacking up, that's exciting to me. Because that means now we know that we're not doing what we should be doing, and now we can start looking for real answers and measure the results of putting those answers in place. So I wanted to thank you for your time and patience. I hope this has been useful. If you can think of anyone else in business that needs this sort of information, please forward the links. We'd love to help as many people as we possibly can. And other than that, I want to thank you for your time and your patience. If there's any other questions, I'll endeavour to answer those after the webinar. But thanks very much for your time, guys. It's really been great. Cheers.